Good afternoon, everyone. My name is Denise Appleby. Thank you so much for joining us today. And thanks to Colin for doing this presentation. If you've attended any one of my Roth sessions, you know I know about the operational aspect, the technical rules, but the questions that I'm not equipped to answer is when is a Roth IRA suitable for one of your clients? When is a Roth better than a traditional IRA and vice versa? And that's why Colin is here today to show you how you can make that decision and the factors that are taken into consideration. So, Colin, I won't take up any more of your time. Please take it away.
Thank you, Denise, and thank you everyone for joining today. Very excited to go through today's topic, and this is slightly different from some of the presentations I've done in the past around modeling Roth conversions for clients. I oftentimes find myself setting up like sample clients to display the stuff so that it always looks great if they convert a massive amount from their qualified portfolio into Roth. But Denise and I were connecting on this call and figuring out what might be a good course of action to go over kind of addressing the suitability. And I think it is important to discuss situations where maybe it isn't the best solution, or maybe there are additional questions I would need to ask of the client to better understand whether or not this is suitable. And Denise mentioned that I am equipped to answer that question. I'll just add to that the software is equipped, thankfully, and I do know how to use the software when we talk about MoneyGuide. But that's what I'm going to be using today to kind of go over the suitability of either a Roth conversion or even potentially making the decision between how a client should be saving from one year to the next, whether, if they've got the capability within their 401k to make some Roth contributions, or maybe their Magi is such that they have the capability of making just pure Roth IRA contributions. What does that look like to their overall financial plan, making that decision versus maybe amping up their pre-tax contributions. So I'll start by saying, we'll do very high level overview of some of the sample clients that we're looking at. But really, the main thing I'm trying to get across today is how to discuss with a client the long-term impact of either a Roth conversion or Roth contributions within the context of their financial plan. And I do think that's important. When you start looking at maybe estimates of like an average return result, and maybe you're just making a really basic estimate about what distributions are going to look like for a client in retirement. Sometimes I think we're missing the mark if we're not connecting it to their own personal financial plan and the goals that they have for themselves. Um, so obviously, I'm going to be using MoneyGuide. I'm the director of training at Envestnet MoneyGuide. There may be other software that you're using that could do similar things to what we're showing today. But if you are interested in some of the things that I show, I'll have a slide at the very end on where you can get more information on our tool. But with that, what are we covering more in general today? I'm going to start by analyzing the long-term impact of a Roth conversion using the tax planning feature that you'll find in MoneyGuide. The first example we look at, we're going to see kind of across the board that I would say, somewhat makes sense for the client in terms of tax savings, legacy planning, which is a big part of a Roth conversion. One thing we also want to make sure we're being mindful of is what does it do to their Medicare surcharges, right? So are we pushing them into higher tiers potentially by converting a bunch to Roth, or vice versa? Are we bringing them out of some of those higher tiers in the later years of retirement by reducing their RMDs? So we can do a really good job of analyzing those things. But most importantly, what impact does it have on that client's ability to fund their goals? And that's a really big focus for us, at least in on the financial planning software side, is especially in a goals-based world like MoneyGuide is in, what does that do to their probability of success? Um, what I'll then do is take that case study one step further and show the stress testing of future tax changes. In particular, what if things get a little bit worse in terms of taxation long term? And I know there's differing thoughts about what the future of the IRS is going to look like. This is going to depend completely on multiple elections if you're talking about a 40 or 50-year financial plan. So I know it's really easy to get short-sighted, take a look at, what the current administration looks like, maybe one administration out and what that might do. But when we talk about the impact of a Roth conversion, maybe even for a younger client than what we're looking at today, what's really going to matter is taxes 40 years from now when that client is in the stretch of their retirement. So I'm not going to pontificate about what I think is going to happen with the IRS or anything like that, but I do think it's an important thing to stress test. Our approach and our tool is let's go with what we know today. One thing you can decide to either sunset or not is the Tax Cuts and Jobs Act. We leave that up to you as the advisor. But I just want to make a really general statement where what if the tax situation is a little bit worse here in the future than it is today? What does that do? Then we're going to move to a different case study where we're identifying some of the complicating factors. So, what do I mean by that? There might be a situation where showing a Roth conversion long term does save the client taxes. That doesn't necessarily mean that it's still the best fit. And the best example I usually have with that is, if I'm showing a client doing a Roth conversion today, obviously increasing their tax situation here in the short term as we're executing that conversion, even if they're saving taxes nominally because they're in a higher tax bracket later on in life, just simply paying those taxes earlier rather than leaving those dollars invested oftentimes will offset a good portion of those tax savings. So we're going to see that, what that looks like within a plan. But then we're also going to say that even for that type of client, it still might make sense for them to opt for Roth contributions rather than traditional contributions. So we'll talk about what to look at there and then leave some time for Q&A as well. So Luis, I know you asked for the PowerPoint there. This is really the only slide I've got other than my call to action slide. I'm going to be spending the rest of my time today in the software looking at a case study. So there really isn't a whole lot in the way of the PowerPoint. Um, Okay, somebody asked about modeling large six-figure conversions for clients in their 60s, 70s, all that good stuff. We're going to see a pretty similar example to that. So if we have any follow-up questions, I'll be happy to answer those as we wrap up today. But let me go ahead and just take a look at our first sample client here. So these folks are in their mid 60s. They are approaching retirement. So they are kind of at a point now where they're maybe getting into a period of their life where they're in a lower tax bracket. So right now, see their employment income while they're working for another year or two is 380,000 pre-tax. For most folks at this point, the year they step into retirement, assuming that's happening at the same time for Stephen and Melinda, we would typically see a drop in what their marginal rates look like for a couple of reasons, right? They don't have this employment income to start with. Um, for funding goals, they might have cost basis that they can draw on. They might not have RMDs until potentially 10 years after they retire. If they're retiring at 65 and based on their date of birth, it would be 75. And then finally, we can have a conversation, which we're going to see here shortly, around Social Security filing. So they can retire at 65, but then decide to delay their benefits until age 70. And there's a benefit to that in and of itself, but it also creates a better conversation around a Roth conversion. Okay. So we'll see that here shortly, but main thing here, relatively, I would say high income earning clients approaching retirement. Um, Last thing I just take a look at, these clients have very significant qualified dollars. So that's another thing that really makes them a great candidate for this discussion. They do have, and I just built in some kind of basic assets here. But of their 2.2 million in their investable assets, only 800,000 of that falls outside of that qualified conversation. So they've got a good portion of their portfolio wrapped up in qualified money. So the first thing I want to do is just get a little bit of a lay of the land where this client is today. If I go to their recommended scenario here at the top, we've already analyzed what their goals look like. We've talked about what resources are available to fund those goals. And right now they're within their confidence zone of what we would deem to be appropriate at 81%. So when you get to this step, at least of our tool, there's a strategies box here in the top left that represents what I like to call non-lifestyle changing recommendations. So what do I mean by that? These are conversations that we could have with the client that might further improve that score that you see there of 81 without asking the client to sacrifice their lifestyle. So without asking them to work any longer, spend any less, or save any more. And we're going to see two of them. One very quickly here, Social Security. And there's a method to this madness here. I know, when you decide to file for Social Security is not necessarily directly related to the Roth conversion conversation, but it is going to enhance what we're looking at. So what this tool is going to show, just to give you a really brief overview, is the most common Social Security filing strategies that we see folks opting for, the impact that that would have on their overall lifetime benefit. So, based on their life expectancy and all that good stuff, how much in total dollars are we expecting them to receive from the Social Security Administration? And then also directly, how does that impact their probability of success? So we saw this on the previous slide. They're filing as soon as they retire. That's their decision that they came to me with. In which case, we saw that gave them an 81% probability of success. This decision alone is going to continue to move the needle up to 90%, so the top end of their confidence zone. And as a reminder, this is not saying you need to work until age 70. They're still retiring at 65, just deciding to delay their Social Security benefits and get that 8% increase each and every year after full retirement age. Okay, so I'm going to go ahead and make this my solution for them. And I know I really hit that very high level. There's a behavioral finance side to that decision that I need to acknowledge. A lot of uncertainty around Social Security. I use my dad as an example. He retired at 65, which was also his full retirement age. I could have shown him that page all day long. He wasn't changing his mind on filing as soon as he retired. So there's a behavioral finance side to it, but we're trying to give you the tool to have that behavioral finance conversation. And in this case, because of the significant increase, I feel like it does make sense. So what I want to do now is turn my attention to tax planning, where we're going to get into that Roth conversion. But before we do that, just to show you what this illustrative tool is highlighting, what we're looking at here are all of my clients' taxable income sources throughout retirement. So this is not going to kick in until the year that they retire, which does happen to be the current year for them. But just think about that if you're working with a younger client here. This display at least represents their retirement period. Now, what we're stacking those taxable income sources against are the various tax brackets. Okay. And you can tell here based on the percentages tied to these, like the 12% bracket continuing on past 2026, I have turned off sunsetting for this particular client. So I'm assuming in this case that the Tax Cuts and Jobs Act will continue. And that's why we see those rates staying the same even as we pass that 2026 threshold. So, a couple of things of note. One, the reason why I wanted to go to Social Security first is because we can see here Social Security is showing up as a delay of 5 years into retirement. They're not getting that because of that decision we made. The other really significant delay of income are their RMDs, which we have kicking in once they get to their RMD age. Okay. So, what that's done for us is created this period at the start of retirement where they are in a very low tax bracket. They're actually below the 12% bracket for the most part, dipping into that ever so slightly in some of those years where their investment earnings are a little bit higher. Okay, so this is a trial of Monte Carlo that we're looking at. I'm trying to get my mouse on that. See if I can zoom in, highlight that a little bit more clearly. Maybe not. You can see those investment earnings popping up 42,000, and that's the reason why they're in the 12% bracket even in that second year of retirement. So what this opens up for me is an opportunity to discuss doing a Roth conversion during these years when we're in a lower tax bracket and hopefully prevent, for the most part, our clients even getting into that 24% bracket later on in life. So what I've done is I've set up a Roth conversion here for Stevens qualified assets. And I'm going pretty simple with this right now. I am going to convert enough each and every year for those first 5 years of retirement to fully maximize the 12% bracket. So what we're going to see when I turn this on is a new taxable income source that takes them right up to the threshold of that 22% bracket that I've got my mouse on. So if I turn that on, and by the way, you can click into that and do a specific dollar amount that you want to convert. I do oftentimes hear advisors saying though that, if this is a long-term decision, it's not happening for a few years down the road. I'm not telling a client an exact dollar amount that they're going to convert. We're going to have to see where we are in that given year. I think this is a much better approach just to make a general statement to the client that we're going to take advantage of those lower tax brackets while we have that opportunity. So notice the amount converted is the exact amount each and every year to fully maximize the 12% bracket, getting them right up to that 22%. Now, over here on the right, we can see the result of that is for this client over their lifetime, about $141,000 in total lifetime tax savings. And the reason for that is because we don't have any of these years down the road where they're being taxed at 24% on the federal level. By the way, one thing I didn't tell you about this client is that they do live in California, so their state taxes are also contributing to some of those numbers. I only see the federal here on my chart, but that's a big reason why these clients are saving so much in the form of income taxes. Now, how do we get to that? I can change this to what's called taxes view. And I think this is really important if we're trying to connect the dots between this conversation and the conversation that maybe the client needs to have with their accountant. Because oftentimes I hear this from advisors as well, that convincing an accountant to do a Roth conversion is another hurdle, just simply because maybe the job is the accountant. They feel like we want to try and reduce or mitigate taxes as much as we can in this current year, and maybe we're a little bit less forward looking. So this is being upfront with the client. What we see here in red represent the tax increases caused by the Roth conversion. The trade-off in green is that once they get to RMD age, we are significantly reducing their tax liability, which is what this is highlighting, every single year for the rest of their life with the reduction in those RMDs. And that minus the additional tax spending is what relates or translates to that total tax savings. Okay. So to me, that's step one. Just seeing this very significant tax savings does not tell me necessarily that this is a suitable thing for this client. It probably is. With that amount of tax savings, that looks pretty good. Um, but another thing I might want to look at least high level within this display, is the impact on asset values. Because when we think about a Roth conversion, another advantage that it creates is a legacy planning advantage, where if I'm passing Roth assets to my heir rather than those pre-tax, they're going to be able to withdraw those completely tax-free as well. So this is where we can hit that at least high level. There's a lot more detail around this within the plan itself, but this asset values drop down allows me to see, with the strategy in place versus without, the at least in this trial of Monte Carlo, how much more is left over at the end of the client's life. There's about a half million more. Furthermore, close to 2 million of that is in Roth. So everything I'm seeing here in terms of these totals represents a pre-tax value. The after-tax value that this is creating, I would say, is far greater than 500,000, because a huge chunk of that is now withdrawable tax-free as well. So we're not even really taking it to that extent, but that's another conversation that I can have here. Finally, Medicare results allows me to see what this does to their overall Medicare costs throughout retirement with this Roth conversion in place. And this is actually a really perfect example, because you'll notice, because their income was so low, their MAGI was so low in those earlier years, the Roth conversion amount doesn't even get them into tier one. But you'll notice here, if I turn this Roth conversion off by just unchecking this box, take a look at where they are in some of these later years. If they have those really significantly high RMDs, we're going to find ourselves getting into all the way up to tier two, and even tier 3 or 4 after that first client passes away. So with this Roth conversion, I'm not subjecting them to higher Medicare surcharges during the period of the conversion, but I am helping reduce some of those in the later years. Okay. So we've got income tax saving, Medicare savings, better legacy situation we're able to kind of see here. The last thing I want to kind of check the box on is, what does this do to their ability to fund goals? So if I go to probability up here at the top, this is going to bring that back into the conversation. And you may have been expecting a more significant uptick, but on the left, we've got, here's your probability of success with the strategy in place. On the right is without. And, first thing I'll mention is, once a client's probability starts to get up into the 90s, we don't see that increase happening very easily. In other words, once a probability is extremely high, it takes quite a bit to move the needle significantly. The other side of this is, they are giving up some growth potential earlier on in their plan by paying those taxes earlier. That said, the tax savings, the Medicare savings, um, certainly create an advantage. We have further increased their ability to fund goals in this plan. So I want to click return to recommended. If we feel like we were disappointed in only seeing a 2% increase, where you really start to see the value in something like this is especially if there's a change down the road to tax code. Now, if taxes are more advantageous for this client, so in other words, rates go down, or whatever might happen down the road, obviously with or without this conversion in place, things are going to look better. What I might be worried about is if taxes go in the other direction. So something happens with the IRS. It could be any time throughout this client's life. but their tax situation starts to look a little bit worse. I can stress test that here on what's called the what if worksheet. And I actually went ahead to save us some time today, built out these two situations. But you're already familiar with these first two. Their base plan is without the conversion in place. Right next to that, we saw just by simply turning that conversion on a further increase in probability. Um, then to the right of that, I'm getting a little bit pessimistic. What these two scenarios are looking at is if when we get to retirement, the client's tax rates increase by 25%. So to be clear, what I mean by that is just to give you an example, if their current effective rate is like 20%, this would take their effective rate up to 25%. So when I say a 25% increase, that wouldn't take it up to 45. I think is sometimes the confusion when people create this stress test. But one is with the base plan. So without the conversion in place, if their tax situation gets that significantly worse, we go from a 90% down to 80%. With the Roth conversion in place, knowing that we've gotten some of that money out a little bit earlier when taxes were looking a little bit better, this is where we start to see a more significant uptick or advantage of having that in place. So that's what I see over here on the far right is the same assumption around a tax change, but they do take advantage of that Roth conversion in those earlier years of retirement. Okay, so that's again just stress testing. And if you're familiar with MoneyGuide, you may or may not be. I'll just show you what I did here. You go down the screen, it can start to get a little bit overwhelming, but these red dots will call attention to some of the differences. So as we go down, the first one I'm going to notice is just the Roth conversion being turned on in those two that we pointed out. And then finally, at the very bottom is where you find this ability to change tax rates in a specific year. I just kind of randomly chose 2035, and there's that 25% increase in those. Okay. So just a great way to highlight some of the additional advantages that could be created in the event that that tax code changes dramatically. Okay. So again, I'm not making any promises that that's going to happen. It's just simply a stress test, right? Which is always important when we're planning. I'm going to turn my attention now to a client where the Roth conversion, maybe on the surface, seems like a good idea, and it still could be, but maybe it just doesn't have that impact on probability of success that we're expecting. So, Mike and Sarah, what makes them different from our previous sample client is a they have quite a bit less in qualified money. More of their portfolio, I think they actually already have some existing Roth, but more of their portfolios in non-qualified taxable assets rather than qualified. So there's a little bit less of those really significant upticks from RMDs in the later years. Um, the other side is Mike and Sarah are a little bit more pessimistic about Social Security, so they're less willing to wait until age 70, which creates a little bit less of an opportunity in those first few years. So just really quickly, let's take a look at their recommended scenario. And I think this perfectly highlights a situation where taxes are being saved, uh, but that doesn't necessarily translate to an increase in their ability to fund goals. So we're going to see an example of that here with Mike and Sarah, who currently find themselves at about an 83% probability of success. If I go to tax planning over here on the left, similar to our clients before, we do not have that Roth conversion turned on right now. And notice they do still have some significant RMDs later in life. There's two kind of factors with that. Number one, these clients are younger, so even though they don't currently have as much in qualified money, we are expecting that to continue to grow until they get to retirement. But you will notice the income that it takes to get to some of those higher brackets. You see that slight upward slope to it. We are assuming that those go up with inflation as well. So even still, without a conversion in place, they don't really come anywhere close to getting into that 24% bracket that the previous clients found themselves in. Okay. So I can set up a Roth conversion here. What if I max out? I'm going a little bit more drastic with these clients because you'll notice they're already past that 22% line in most of those earlier years. So let's go ahead and max that out. I'm going to choose to include this Roth conversion. And again, just to quickly point out what I've done here, the only difference is we're maxing out that 12% bracket. Okay. So we see more significant Roth conversions in those earlier years. The payoff is every year after that, they're falling below the 22% bracket. So they're basically taxed at a highest rate of 12% throughout the rest of their life because their RMDs have been so significantly reduced. And that does pay off, not nearly as significantly, but we do see that that does save them about $16,000 in estimated tax savings. And I haven't touched on this yet, but I think it is worth noting. I keep saying this is just for this one Monte Carlo trial. Down here at the very bottom of this tax planning feature, if I go to market test, I can change that assumption. So I can actually look at this exact detail at the top for all 1,000 trials that we're running within this tool. So I can look at, hey, if market returns are really bad, and I look at the 900th trial, you'll notice that that completely changes the amount that's being converted within each year, and it also results in more significant tax savings. Okay, so it starts with that median trial, the 500th, but you can change that down there at the bottom. Okay, so we've got tax savings, that actually resets my 500th trial because I moved away from it. In this case, we're actually paying more in taxes now. Um, but I can take a look at Medicare results. You'll notice we are increasing their Medicare premiums as well. It's basically an opposite story from what we saw with the last client, where we are pushing them into tier one in those first years of retirement. And this kind of tells me that they probably weren't even getting into that in some of the later years. So that has caused an increase in their Medicare premiums as well. Furthermore, and again, looking at some of these trials that we looked at before, there are situations where there's significant tax savings. So if I go back to that really bad trial, this is where we saw about $60,000 of tax savings. I still see some there here as well. If I go to probability, though, this does not necessarily translate to an increase in probability. In fact, it goes down by 1%. So this is, again, not a hugely significant downturn, I would say, in probability of success. And I don't typically see a Roth conversion completely swinging a plan that's like failing into being really successful or vice versa. But it does slightly decrease their ability to fund goals, taking such a significant amount out and taxing it in the earlier years. So we could noodle with this strategy a little bit, maybe change the amount that we're converting. I will just quickly point out some of the inputs for this. I've really been focusing on allowing the system at MoneyGuide to calculate the amount that's being converted based on maximizing a desired bracket. But you do have the ability as well to enter your own amount rather than maxing your bracket. So I could just say, what if we converted 20,000 per year? Um, Again, I mentioned one of the difficulties with that is for someone who, like these clients, isn't retiring for another 10 years, getting so specific with a dollar amount, I don't personally think is the best approach. Maybe if they were saying how much should I convert in the current year, that would make a little bit more sense. But since we're talking about 10 years from now, I really do appreciate kind of the more general statement. When we get to Mike's retirement, we're identifying that we're in a lower tax bracket. We can do what we can to kind of fill the headroom within some of those lower brackets by picking which bracket to fill here at the bottom. So those are kind of your two options for that approach. So in this case, slight decrease in probability of success having this conversion turned on. What I want to really quickly show you, and this is one of the last things I wanted to get into before we open it up for some questions, is the impact of Roth savings instead. So just because taking a massive amount out of their qualified portfolio, moving over to the Roth, doesn't necessarily have the impact we wanted it to, that doesn't mean that future Roth savings aren't a good idea. So if I go to my what if worksheet again, and this is a really common tool used to model some of the more advanced things you want to show to the client. What I've done here is built out, and I'm actually going to go ahead and turn off that Roth conversion to recommended. I meant to do that before we left that feature, so bear with me one second. I'm just going to go ahead and turn that off, recalculate. So I wanted to get that recommended scenario back to not having the Roth conversion turned on. So maybe we've decided, based on what we saw there in that previous tool, that the Roth conversion doesn't make as much sense. What we're comparing now is with that Roth conversion, which we saw brings it down to 82%, versus rather with Roth contributions. So what I've done here in this particular scenario is I do have the Roth conversion itself turned off, but if I scroll down, there's an entire other section where I can make adjustments and assumptions around what they're saving and how they're saving. So it's going to be this additions to existing and new assets section. Okay. and they are currently making 14% contributions to their 401k. So they're only getting a match up to 8%. So for whatever reason, this client has decided to throw more in that 401k than they're getting in terms of the match. So that might be a conversation in and of itself to talk about, hey, let's, you know, maybe bring that out and we can manage that separately from your employer sponsored plan. But all I've done here is said, all right, I don't want to leave money on the table. Let's take full advantage of your pre-tax match there at 8%. What I can then say is that we're going to take that other remaining 6% that you're already doing and put it into the Roth side of your current 401k. Okay. So that decision alone, and obviously the longer the time horizon between now and retirement, the more impactful it's going to be. With these clients only being about 10 years out from retirement, we don't see a significant uptick in probability, but we do see that occurring. And then another thing maybe worth taking a look at would be things like these safety margins here at the top. So probability of success is very important. What I think this helps highlight is the additional growth potential with these contributions rather than doing that Roth conversion. So what I notice here is if we got this portfolio's average rate of return every single year, what we would see left over after funding all their goals is about 4.8 million versus 4.2. So an increase of about 600,000 in their end of plan portfolio assets. What you can also see is the purchasing power of that. So we take that same value back into today's dollars, which I think is helpful oftentimes for clients to really understand what 4.8 million is going to mean for them. We're talking 30 or 40 years from now. So that would translate to about 1.8 million in current purchasing power versus about the 1.5, 1.6 with that conversion strategy in place. So a number of different areas that we can hit on. And I think the main takeaway here is that just because taking a bunch out of what's currently invested in qualified, converting to Roth didn't have the positive result we were expecting, that doesn't mean that for that same client, it wouldn't make sense for them to start making some Roth contributions and see how that impacts their results. Okay. That gets me through most of what I wanted to talk about today. Let me go ahead and bring my PowerPoint back up here. And I just have a couple slides I'm going to show here. So as I'm looking at the questions that came through, I just wanted to flash this slide up for anyone who's maybe less familiar with the MoneyGuide tool, like what they saw today. There's obviously a lot that this tool has to offer that was not covered in kind of this more topic specific discussion around Roth conversions. But if you have any other questions on just getting more information on pricing or what it might look like for your firm, I do have some contact information down here at the bottom, the phone number as well as the email address to reach out to our sales team, and they can figure out kind of which of these solutions that we see here would work the best for you. With that, I'm going to take a look at some of these questions that have come in. I'll come back to this slide. I do, for the purposes of compliance, need to flash my disclosure slide as well. So I'll leave this up as I start looking at some of these questions. Okay, let's see. So somebody asked, how difficult is it when when they are already in retirement and collecting pension, Social Security to avoid the IRMA penalties? So the IRMA penalties, and again, I'm sure I'm telling you stuff you already know here to an extent, but they do have that 2-year look back. So there's not a lot they can do for those first 2 years because that's going to be looking at their years of employment to get what that modified adjusted gross income looks like. But what we are able to show today is that, maybe during those first few years of retirement, when they're in a lower tax bracket as well as falling below the tier one of Medicare, we can take advantage of that by getting some of that money out of qualified, not allowing it to continue to grow there, subjecting them to those higher Medicare tiers. So once they've started filing for Social Security, if they've got a pension, there's not much you can do around those specific things. But I do think that if they have a significant qualified balance, there's certainly some strategies that could improve that. Does this assume that the taxes are paid from the IRA conversion or other outside savings? Great question there, Anna. So what I was showing you earlier with the Roth conversion, we are assuming that the first thing we're going to pull from is the client's taxable cost basis to pay those taxes. If there's nothing left in that category, we then move to actually using the Roth amount instead. And there's a really good reason for that, because when you select to max out a certain bracket, if we then start pulling from qualified money to pay that tax bill, we're now pushing you above that desired bracket. So we do try our best to pay those taxes from a source that would not continue to increase their tax liability for that year, especially if you've told us what bracket they'd like to stay within. So to start with, we use kind of our typical spending order, which is taxable cost basis. But then to continue to try and avoid pushing them into a higher tax bracket, we'll start to look at their Roth balance to pay those taxes. Great question. So will MoneyGuide Pro tell us the optimal amount to convert and how much to convert each year? Um, n- it will tell you how much to convert each year, Mike, if you're looking to maximize a certain bracket. What we don't have built in at this time, we've got something called a super solve feature that finds a balance between working longer, spending less, and saving more. We don't have necessarily like a quick solve feature to say, here's the ideal amount each and every year. Because the problem is, if you're looking at 1,000 trials, that's going to vary within every single year of every single trial of Monte Carlo. So the best we've got right now is to say, I want to stay below this specific tax bracket. In which case, we will tell you within every single one of those 1,000 trials what it would make sense to convert. Um, the other complicating factor with the word optimal is now that we're able to kind of display, which this is a relatively new update, but now that we're able to display where they fall within those IRMA brackets, that's another side of the coin, right? We do want to reduce taxes, but if we're increasing significantly their Medicare tier every single year, that's going to completely offset it. So finding that balance you can visualize within our tool, but we're not necessarily calculating that optimal amount. So I like that. That's a great question. Backdoor Roth. Do you recommend converting immediately or waiting to avoid the step up in basis issues? Um, you can show the backdoor Roth in MoneyGuide. One thing you are going to be responsible for is kind of telling us what tax rate you'd like to use on that conversion. So there is the ability, everything I showed you today was showing a conversion during retirement, because that is typically where we see those really low tax brackets. But you could certainly take advantage of that during their working years. If their MAGI is above where it should be for Roth contributions, you can show those conversions in those earlier years instead. And I don't know if I can say the do I recommend converting immediately. That's definitely going to be client by client based, but it's certainly something you could model within that client's plan to determine the level of appropriateness. Just to verify, the Roth modeling was conducted under MoneyGuide Elite and not MoneyGuide Pro. So that's a great point there, Charles. So what I was looking at was MoneyGuide Elite. So that tells me you're familiar with some of the different pricing options that we've got. We do have MoneyGuide Pro. I would say most of the new sales that we see coming in are going the way of MoneyGuide Elite, which does provide that tax planning feature. That said, if you're using MoneyGuide Pro, we still have that exact same Roth conversion strategy available to you on the what if worksheet. You can still choose to maximize a certain bracket. You can choose which scenarios you want that turned on and off in. What you're missing is just that really good visual tool that I showed today, where we're highlighting, all of those really key factors: legacy planning, tax savings, probability of success, all in one place. That's what you're missing, is that tax planning feature itself. But we do not take away your capability of just simply showing that strategy, really in any way when it comes to elite versus pro. But that is a really good point there. Does MoneyGuide show how much of a Roth IRA distribution is taxable? So yes, you would see that in that tax planning feature as well, if there was any taxable distribution. For the most part, we are going to assume that an existing Roth account has been in place for 5 years, so we wouldn't necessarily see any penalties on those withdrawals, and that those that were growing completely tax-free, distributed tax-free. But what comes to mind for me in particular is if someone's got in their 401k pre-tax additions they've made, Roth additions that they've made, and then they also might have some after-tax non-Roth contributions that they've made. You're going to see all of those different distribution types happening. Roth won't show up on that chart I displayed because it would be tax-free, but those other two certainly would. So you can see the breakdown there on that chart of what is considered a taxable distribution versus tax-free. Okay, last one that I'm seeing right now, unless something else comes in. how does the taxation of Social Security factor in? For example, the client does not pay any taxes on Social Security, and then after the conversion, 85% is taxable. Will MoneyGuide help calculate this, as well as state taxes for Minnesota, for example? Okay, so a couple things there. We assume as a default that 85% of Social Security is taxable. So actually, what I was showing there on that tax planning module was really only 85% of their total Social Security income. Now, we have another feature called total income, which is a better tool for just showing where's your money coming from one year to the next in retirement. And that will display 100% of their Social Security, because that's really the topic of discussion. Within tax planning, though, we're only looking at their taxable income sources. So all I would have seen there in that tool was 85%. One thing to understand is that we are not dynamic with that. So if you have a client who's, based on their income level, maybe only 50% of their Social Security is taxable, or 0% of their Social Security is taxable, that is something you need to go into the tax and inflation options section and let us know. So we are dynamic with quite a bit around taxation in the tool, but taxability of Social Security is not one of them. We assume 85% for all clients, and that does need to be adjusted if that's not applicable. We also do incorporate state taxes into the plan. I will say that there are some, and this may be what you're asking about with Minnesota, there are some weird state by state rules where distribution on qualified assets are not taxable on the state level, but they are on the federal. Um, we do not follow, I would say, all of those, because they do vary so greatly from one state to the next. So I would say, if anything, we're probably being more conservative. And if that does apply to the state of Minnesota, I don't know off the top of my head. Um, that is something we'd probably be overtaxing in the tool. So there are some workarounds, and that's definitely an area where we're looking to make some future enhancements. But long story short, while we do have each state's specific progressive tax brackets, or if you live in Texas or Florida or one of those, there's no tax in state income tax. So we have all of that incorporated. There are just other more specific rules around things that are or are not taxed on the state level at all, that we don't necessarily keep up with each and every one of those. Okay, that was a lot of really good questions, and I really appreciate that. I am going to hang on the line a little bit longer and see if we have any other questions. But what I'll do now is just turn off my screen sharing in case Denise had something else that she wanted to share there. Let me see here. There we go. And say another quick thank you to everyone for joining today. Hopefully this was a good use of your time, and hopefully Denise and I can work together again to deliver some content in the future. But yeah, let me know in the chat box if you have any additional questions. Otherwise, thank you as well, Denise.
Oh, thank you for doing this, because you've answered all the questions that I couldn't answer, and I'm sure the audience appreciates that. I'm going to be sending out one of my quick reference guide that explains the different ways in which a Roth IRA can be funded. And I'll be doing an upcoming webinar on the different ways in which you can fund a Roth IRA. And my presentation combined with this, I think, gives you the full picture, because you're going to be able to tell your clients if, when, and how they can fund their Roth IRA. I'm going to be looking at how do you determine if a distribution from a Roth IRA is taxable. So that combined with this gives the full picture. Any more questions?
I'm not seeing any. There was one other question that came in around the phone number. So again, we had that up a moment ago, but that's 1-800-841-5312 is the number to get in touch with our sales team. And as always, you can email sales@moneyguide.com as well.
So the question from Mike Branch was answered. How will MGP tell us the optimal amount to convert?
Yes. So that was the pretty much no. We're not going to tell you that, only because of how much that might vary from one trial to the next. But it will show how much to convert to stay within a certain bracket that's selected. So, yep, that was a good question.
And Leah just submitted a question.
Oh, yep. So is there a report that could be provided to a client when making a presentation regarding the conversion, something that they can take away, not just, yes, absolutely. So all of the display that you saw there with the taxable income stacking against um, the various tax brackets, that is a printable page. And there's a lot of other detail from that tool that can be slid into the report as well. One thing I will say is just that whatever uh, strategy you have turned on within that recommended scenario, that's what's going to carry over to the report. So if you've been discussing a Roth conversion, you're clicking it on, clicking it off, just make sure whatever you want to print is selected within that section before going to the report section. Because if you deselected it and you generate the report, it's not going to show up there either. So just make sure those strategies are turned on.
Fantastic. Thank you, everyone. If you have any questions that you think about after this, please feel free to email them. Colin, I don't know if you want to share your screen again, just so they have your contact information.
Sure.
And I'm going to be sending out a copy of the slides that you included so they have it anyway.
Okay. Yeah.
Thanks again. Thanks, everyone. Enjoy the rest of your day.
Thank you, everybody.